A stock drops, 4.6% on significant volume right after an earnings call. Now, that usually signals, a big operational miss.
Right. You expect bad news.
But what happens when the core business is actually performing, well, flawlessly? That's kind of a financial mystery, isn't it?
It really is.
Welcome to Talk Tickers. We give you the professional summary of today's most important earnings calls.
And today we're diving deep into equity lifestyle properties, ticker ELS. This is following their third quarter 2025 results released Thursday, October 23rd.
Yeah, and our mission here is really to understand this fundamental paradox. Why did the market react with so much skepticism? Especially when the company delivered, strong core metrics and, importantly, maintained its full-year guidance.
Mm-hmm. The caution was definitely there. You felt it.
Oh, yeah. Closing down 4.6%. That kind of drop suggests the market saw a weakness, a specific one, that just overshadows some pretty significant operational wins.
So we need to figure out what spooked them. Okay, let's start with the results snapshot. Q3 2025. Normalized funds from operations, FFO, came in at 75 per share.
Okay, 75 cents.
Which is a decent 4.6% growth year over year, and it landed squarely in line with consensus expectations.
Right, and in line, well, in this environment, sometimes feels like a miss, doesn't it? Investors are really hunting for that upside beat.
That's true. Interestingly, though, their GAAP EPS, the accounting earnings, looked stronger. 0.50. That's actually a 12.9% year-over-year increase, and it did beat estimates.
Okay, so a GAAP beat. What about revenue?
Revenue was a bit mixed against consensus, came in at $393.3 million. Modest growth, 1.6% year-over-year.
So right there, you can kind of see the issue starting to form. No FFO upside, mixed revenue.
Exactly. But, and this is key, if you dig just a bit deeper, look at the underlying assets. The operational performance itself was stellar.
Okay.
Core net operating income, NOI, before property management costs, grew 5.3% year-over-year.
Wow, 5.3%. That's a strong number.
It's a fantastic metric. It tells you the properties themselves, they're generating healthy revenue growth and they're managing costs really well.
Okay, so strong cash flow growth at the property level, a GAAP beat. Yet the market seems to have focused entirely on that lack of FFO upside and, well, something specific going on in the RV segment.
That's precisely it. The stock sold off on what you could call the downside of operational bifurcation.
Bifurcation. Okay, explain that. Like a split.
Exactly. Let's unpack this tale of two businesses within ELS. On one side, you've got the operational pillar, the vast majority of their asset value, manufactured housing, or MH.
Right, the MH side. That's always been their core defensive story, hasn't it? The compounder narrative.
Absolutely. Core MH rental income increased 5.5% year over year. And management really highlighted the simple, powerful economics here.
Which is?
A new manufactured home costs about 60% less than a comparable site-built home nearby.
60% less? That's a massive affordability gap driving continuous demand, you'd think.
And you see it in the results. Florida, which is a key growth market for them, saw MH occupancy reach 94%.
94%, okay.
But what's really fascinating, I think, is the mark-to-market data they mentioned. It shows enormous embedded growth potential.
Okay, explain that for us. Mark-to-market. They mentioned a 13% increase for new home buyers in Florida. What does that actually mean?
Yeah, it signifies their pricing power. It shows this huge difference between what their current long-term tenants are paying. They benefit from those lower historical rates, and what a new buyer is willing to pay today just to get access to that land in a desirable spot.
Ah, okay. So that 13% is like untapped potential they capture when homes turn over.
Exactly. Pure embedded growth potential. It's a really clear structural advantage.
And it sounds like that growth is pretty visible for next year, too.
It is. They noted that 50% of the MH rent notices for 2026 have already gone out, and they're projecting an average rate increase of 5.1%.
5.1% locked in for half the portfolio already? That kind of visibility, that durable, consistent growth, well, that's gold in a volatile economy.
It really is. But here's the other side of the coin, the counterbalance, and pretty clearly the source of the stock pain.
Okay, the RVs and marinas.
Right. Core RV and marina-based rental income saw a slight decline, 0.4% year over year, but the real softness was concentrated entirely in the cyclical short-term bookings.
How bad was it?
Seasonal rent declined 7% year to date, and transient rent, the really short stays, decreased 8.4% year to date.
Oof. Okay, that's definitely a headwind. But before we get into exactly why that happened, you mentioned something about operational discipline. That seems important if they held guidance.
Hugely important. This is really the unsung hero of the quarter. It's what allowed them to maintain that FFO guidance despite, the RV issues that were clearly emerging.
So what do they do on costs?
Get this. Core property operating expenses increased only 50 basis points. That's just 0.5% in Q3.
0.5%. In this inflationary environment, that's impressive. A masterclass in cost control, basically.
It really is. It's like giving themselves a huge operational raise.
Was that structural or just, getting lucky on a few line items?
Well, probably a bit of both, but they definitely capitalized on any good fortune.
Yeah.
They cited some expense tailwinds, like a favorable 2025 insurance renewal, actually down 6% year over year.
Insurance costs down. You don't hear that often.
No, you don't. And they also got some relief from what they initially expected for real estate tax increases, particularly in Florida. Plus, they improved their utility recovery rate, how much they recoup from tenants, by 150 basis points to 48.1%.
Okay, so they're squeezing efficiency everywhere, relentlessly. So the core engine, the MA side, the annual RV folks, tight OpEx control, that's all firing perfectly.
Seems like it, yeah.
Which means the market must have laser focused entirely on that crack in the facade, the RV weakness. Where exactly was the pain concentrated?
It was highly specific and potentially temporary, the Canadian reservation issue. Ah, the snowbirds.
Exactly. The annual migration south to escape the cold. The primary driver of that drop in seasonal and transient demand was reduced bookings from Canadian customers.
Okay, and this is where it gets really interesting, right? Management dropped a pretty staggering number here.
They did. The current Canadian reservation pace for Q4 down approximately 40% compared to last year.
40%? Wow.
And they said they're seeing similar pacing for Q1 2026 as well.
Okay, a 40% drop like that.
Yeah.
That's a shock to the system. It explains why they had to revise guidance so drastically.
Absolutely. It forced a major and probably painful revision. ELS now expects the combined seasonal and transient revenue stream to decline 13.3% in Q4.
13.3% down. That's a huge swing from their prior guidance, which was only down 1.5%.
Massive change.
And what reasons did they give for this sudden drop-off from Canadians?
They pointed to two main things. First, political issues impacting U.S.-Canadian relations, making travel maybe less appealing or certain. And second, crucially, a moderate October weather season. Mild weather. Meaning
it wasn't cold enough up north yet to really push people to book those last-minute trips south? It dampened the urgency?
Okay, so the takeaway here is the market sold off heavily on what might be a short-term cyclical issue, driven partly by politics, but maybe more so by mild weather.
That seems to be the read. And this is the point management really hammered home on the call.
Which was?
This 40% decline primarily impacts the seasonal and transient customers, the shorter-term renters. That group is only about 10% of their total RV revenue.
Ah, only 10%. That's a crucial distinction.
It is. It does not affect the annual RV customers. Those are the folks who often treat their sites like permanent or semi-permanent homes. And for that group, annual rent increases of 5.1% are already set for 95% of those sites.
Okay, that puts the market reaction and the guidance hold into much clearer context. Despite this, pretty significant RV headwind in that one small segment.
Right.
ELS was still able to maintain its full-year normalized FFO guidance. Midpoint still $3.01 to $3.11 per share.
Exactly. And that stability really underlines the strength of the main MH portfolio and their operational control. They're offsetting that cyclical softness.
So zooming out a bit, what's the broader investor picture here? How does ELS fit in?
Well, ELS operates in the U.S. REIT sector, and REITs generally have lagged the broader market, mostly due to interest rate sensitivity.
Sure, rate hikes hurt REIT valuations.
But quality MH names like ELS are traditionally viewed differently. They're seen as defensive compounders.
Because people always need affordable housing.
Right.
Regardless of the economy.
Precisely. And this call, despite the RV noise, largely reaffirmed that defensive compounder story. The durable MH growth, the cost control.
But the stock still sold off.
Because investors, it seems, focused entirely on that short-term cyclical softness in the RVs and marinas and the fact that management didn't raise FFO guidance. No upside surprise.
So near-term performance really hinges on seeing that RV softness bottom out and continuing that solid MH growth.
That looks like the balance right now. Their long-term strategy hasn't changed, though. Still focused on organic growth. Filling up existing sites, they added 476 annual RV sites in Q3, which is good progress.
Site fill, basically paying customers onto empty pads.
Yep. That and executing on rent increases. Management did note that acquisitions are still pretty challenging. It's a fragmented market, lots of private owners who are doing well and don't need to sell cheap.
So internal execution is key.
Got it. Okay, this feels like a good transition point.
Okay.
This brings us to our final segment, where we pitch an outrageous but plausible trade idea based on everything we've just discussed.
And we absolutely have to be crystal clear here.
Yes, disclaimer time.
This segment contains non-financial advice. Strictly, it's a highly speculative thought experiment. It's for illustrative purposes only.
Do your own homework, lots of it.
Yeah.
You must conduct your own extensive research before even thinking about making any investment decisions. Seriously.
Okay. With that very clear, let's look at the setup again. Right. The stock got punished. Why? Because of a Q4 transient RV issue, driven by political friction, maybe, but critically, by mild October weather.
So the argument is the market may have overcorrected, punished the stock too harshly for what could be a temporary short-term weather-dependent risk.
Okay, so if mild weather caused the problem,
What reverses that 40% reservation decline quickly?
cold weather.
An abrupt, sustained cold snap up north. We heard management mention the NOAA Climate Prediction Center forecast.
Right, they mentioned La Nina,
Exactly, calling for a La Nina pattern this winter.
and La Nina typically means, what again?
Warmer, drier conditions in the Sun Belt, which is actually good for long-term RV use down there where ELS properties are. But critically, it often brings cooler, wetter conditions in the north.
Cooler and wetter up north. So if that pattern delivers, say, an abrupt early cold snap, late Q4, or maybe early Q1 2026,
Then the whole narrative around those Canadian bookings could flip almost overnight.
people suddenly get very motivated to head south.
Precisely. So our outrageous but plausible idea is a short-term directional options trade.
Okay.
Think about a modest position in short-dated, out-of-the-money call options on ELS.
Calls. Okay. Betting the price goes up.
Yeah.
Short dated, out of the money. So it's a leverage bet on a near-term event.
Exactly. You're essentially betting on the weather. If northern cities get slammed with cold and snow earlier or harder than expected,
Those Canadian snowbirds, that critical 10% driving the recent negativity, they rush to book their sites.
could lead to a significant positive surprise in the next update, maybe the January or Q4 release, and that could override the current cautious market narrative.
So it's a pure weather bet, designed to capitalize on what might be a market overreaction to a timing issue, driven largely by meteorology. Interesting. Plausible, maybe. Definitely outrageous.
That's the idea. Okay, so let's recap our deep dive. ELS delivered pretty clean execution where it counts most. Resilient manufactured housing, disciplined expense control. They proved the strength of their 90% core business.
Right. The main engine is strong. But the market punished the stock, and punished it hard, for that cyclical, transient RV softness. A business that fundamentally is only about 10%, maybe slightly more, of their overall revenue model. So the challenge for you, the listener, the learner, is really to assess this. Is the market's tunnel vision on that, let's call it 10% risk, overshadowing the consistent, durable, arguably recession-resistant growth provided by the other 90% of the portfolio?
That's the question to ponder. Thank you for joining us on Talk Tickers.
Remember, this material is strictly for informational and educational purposes only. Please continue your own research and analysis.
We'll catch you on the next deep dive.